Hello, my name is David Buckland and welcome to this week's Video Insight. I wanted to ask the question whether the very low inflationary expectations in the 2000s and 2010s decades will be repeated, or should we look back a little further to the 1990s for a guide to the future? Of the 5 English-speaking economies highlighted in the graph below, the US Federal Reserve has been the most aggressive by tightening its official cash rates to a range of 3.75% to 4% since March 2022. This move is the steepest increase in just 8 months since the US Federal Reserve Chairman Paul Volcker set out to crush inflation over 40 years ago. High official cash rates in New Zealand, 3.5%, the UK 3%, Canada 3.75% and Australia 2.85% will start to hit their more highly indebted consumers. Combined with high electricity, gas, fuel and food prices, these economies face a bit of a challenging outlook, and the record low 50-year unemployment rate will start to trend up a little as corporates focus on costs. Nevertheless, it is important to note that the current official cash rates are still very low by historic standards. It's important to point out that pre the very low inflation rates of the 2000s and 2010 decades, and simply accept that inflation expectations may halve from around 8% to 4%, but may not necessarily get a lot lower. That is, the costs associated with many commodities, decarbonisation, infrastructure, defence, budget deficits and demographics may mean the typical target of 1 to 3% could be difficult to attain. Across these 5 English-speaking economies in the 1990s, for example, we typically had official cash rates of closer to 6%, approximately 2%, 3% more than they are currently. Meanwhile, 10-year US bonds have sold off from 0.5% just over 2 years ago to above 4% today, ensuring a significant sell-off in valuation of many growth assets. That doesn't mean they're bad value today though. As English-speaking countries deal with their higher inflationary expectations, investors are naturally going to be more conservative when chasing returns. Gambling on rising asset prices and leverage will be eschewed for higher quality companies with good balance sheets and reliable cash flow. And that's where Montgomery's offerings are placed. That's all I have time for this week. Please continue to follow us on Facebook and Twitter. Thank you.